So today we're going to talk about credit and debt management. All right, so after today, I hope that you will learn more about how to manage your credit and debt, identify different actions or activities that you participate in that could damage your credit. And also we want you to build those skills to learn how to repair credit and learn how different things affect your credit score and the use of credit cards. So why is credit important? First of all, credit is when you borrow money and you make the promise that you will pay it back, usually with interest, and that interest is just an extra fee that you pay for actually borrowing that money. And credit is important because it gives you the ability to acquire goods and services today but pay later. Also, it's important for times of emergency because emergency situations do happen. Also, it's more convenient and safer to carry instead of large amounts of cash. Also allows you to make large purchases such as cars or homes and pay for it over time instead of paying all of it out of pocket. And also it's important to know prospective employers and landlords do look at your credit score because they like to see how well that you manage, how well can you manage credit before they hire you. Because if you're a financial advisor, it's important that you know how to manage credit because how can you advise somebody if you don't understand credit yourself? All right, so we break credit down into the 3 C's, capacity, character, and collateral. So capacity, it helps financial institutions determine the risk associated with lending you the money. Do you have a job? How long have you had that job? How much money do you make each month? So those are some of the questions they ask you when they determine your capacity for credit. Also your character. Do you have any present or future ability to meet your payment obligations? Have you had credit problems in the past? Have you made late payments? You have how many credit accounts do you have? Have you ever filed bankruptcy? And do you consistently pay lenders on time? So those are some different things when character is concerned, because it just deals with your reputation. Lastly, collateral. So that's basically when you pledge a creditor until the credit obligation is paid. So do you have any assets to secure the loan beyond your capacity to pay off? So do you have any investments? Do you have houses, cars, or any other thing that they can use as collateral? So what are some pros and cons to credit? Some pros are it's convenient. Like I said before, it covers emergencies. You build assets, you build your future credit. So you extend your line of credit so you're able to borrow more for bigger purchases. So maybe you start off with a $1,000 credit limit, and that can lead up to a 10,000 credit limit. Some cons, a lot of times because you have a big credit line, you tend to spend more than you normally would. It may limit your ability to save and invest. And also increased cost of item or services due to interest charges, because interest does add up. The more you swipe your card and the less time that you put off to pay on that card. So say, for example, each month you have to pay $15. You're still incurring interest on the amount that you have on the card, because you may have a total of 100, but you only pay the 15 amount that's due. So that's why it's important to, use that credit card to your advantage. So pay it all off before the interest charge hits every month. And that's how you're able to take advantage of credit cards. And, certain credit cards have various rewards programs and things like that. So that's important when shopping for a credit card. And it's also a constant drainage of financial resources. Some economic benefits of good credit: lower interest rates. A lot of times, if you've shown that you have a good history of paying on time, and you have a long history of line of credit, if you go purchase that vehicle, instead of your loan being 10%, it may be 7%. So it does make a huge difference when it comes to making big purchases. Also, the availability of credit. Again, your line of credit can be extended and increased over time. So you have, instead of $1,000 credit limit, you may have a 10,000 credit limit. So those are some of the benefits. Some disadvantages of bad credit: higher interest rates. If you have a bad history of paying on time or you default on loans, this leads to a bad credit history. So when you go to purchase your next car, when you get that loan, a lot of times they're afraid that you might default. So you pay a higher interest rate because they took the risk of giving you that loan. Limited sources of credit, employment opportunities, because again, your credit is a reflection of your character, which goes back to our 3 C's of credit. Higher insurance premiums, and difficulty of obtaining credit approval. So that's why it's very important that you have good credit, because as you can see, credit affects your lives in various different ways, whether it's personal or professional. So right here, we have a slide. So 300 divided by 1,000, 30%. On average, most credit agencies would like for that ratio to be below 30%. So your credit score is referred to your credit rating, which is your Fair Isaac Corporation score, so your FICO score. And it's the number that helps lenders determine how much of a credit risk you may be. And your credit score is based on information on your credit report. And we will get into our credit report on the next slide. So payment history, outstanding debt, credit history, pursuit of new credit, and types of credit. So when you pursue new credit, they have to look into your credit score. And the more you have to look into your credit score, that can often bring your score down a little bit. Outstanding debt, so that goes back again to that debt limit ratio. You want to really stay around that 20% threshold. Payment history, do you have a great track record? So again, it goes to the character, the 3 C's. And so it's also important to learn how that's calculated, because how it's broken down is very important when it goes into your FICO credit score. So some ways to maintain or improve your credit. Limit your spending needs. That goes to your wants versus your needs. Kind of going back to what Mr. Ted was talking about. Look at your expenditures and say, you know what? Shelter is more important than me than entertainment is. So kind of leverage that thinking. Also remember that credit cards are loans, and they're loans with interest. So you have to pay for borrowing that money, and you do have to pay that money back. Try to keep a low balance. Again, you don't want to go over that 20% threshold. Pay loans first. And a lot of times when you pay, don't just pay the minimum, pay a little bit more than the minimum, because that helps with your score as well. Charge less. Keep a record of your purchases to avoid overspending, and decline any credit card limit increases, because a lot of times that makes you want to spend even more, because now you have a bigger credit card limit. All right, so I hope what I shared with you today helps you manage your credit and debit better. Thank you again.